Welcome to the Mindful Money Podcast. This podcast is a weekly exploration into a new philosophy of money through psychology, philosophy, and practical wisdom. In this episode of the Mindful Money Podcast,
law school, business school, medical school, another 200, 300, 400,000 on top of that before you got your first job. How are you going to get out of that? So it's enslaved people in many cases.
All right, welcome everyone to another episode of the Mindful Money Podcast. I have an amazing guest with us today. This guy is America's money answers man. He's been on The View, he's been on Fox News Network, CNN, CNBC, and CBS Evening News. He's got 13 best-selling books, including Everyone's Money Book and Master Your Money Type. This guy's name is Jordan Goodman. Welcome to the show, Jordan.
Great to be with you, Chris.
Absolutely. And hey, man, I've been watching some of your videos, and I'm really excited to have you on the show. I know that you're known as America's money answers man, so you seem to have all the answers and practical ones at that. So
I too. We're going to talk about the psychology of money, but also hopefully some practical things.
Absolutely,
really help people. And I like to give specific phone numbers and websites and practical things that people can actually implement my advice.
That's exactly what we're about here. We don't want to have anybody leave the show without something that they can do today, right now. So I'm glad that you approach things that way. And I'll just kick things off by asking the same question I ask all of the guests, really to get us into a deep space and this story of who you are. Think back to your childhood. Think back to like when you were a kid, and remember your concept of money and what you thought money was and what you thought money did and why. What was that? And then how did that change as you grew up?
So a little bit of biography. I grew up in Rhode Island. My father was a professor at Brown. His father, my grandfather, had made a ton of money literally in the stocking business. He came up with silk stockings in the 1920s and did very, very well with that. His company was called Real Silk Hosiery Mills in Indianapolis. So he made an absolute fortune doing silk stockings in the 20s. And then he met a guy named Mr. DuPont who came up with something called nylon. And he became the first nylon stockings guy in the 30s. So he made millions and millions of dollars, had a big mansion, and did very well. So that allowed my father not to have to make money, really, and follow his passion. And his passion was political science, and he became the Soviet political science professor at Brown for 35 years. So, money wasn't an issue because my grandfather had kind of taken care of it and allowed my father to follow his passion without having to worry about making money as such. Professors are great, but that's not a way to make money as such.
Right.
So in a certain way, I'm kind of combined my father and my grandfather. My father, as far as kind of academic, and I've written all these books, I like to give speeches and help people and kind of intellectual stuff. And my grandfather, and then I'm an entrepreneur as well. And so I've combined the content of personal finance with running a very successful business at the same time, if that makes any sense. So I've kind of
absolutely
combined my father and grandfather. So just to give you a fun story. So in the summer, we had a place in Cape Cod in Hyannis, right on the water. And I started delivering the Cape Cod newspaper at age 9 and was hanging around the newsroom. And by age 12, I started writing for the newspaper, actually. I did the youth baseball column starting at age 12. And the boats go over to Nantucket and Martha's Vineyard from the Hyannis Harbor. And so my entrepreneurial side said, well, I'd go to the newspaper. There were just tons of newspapers that were going to be thrown out, kind of the overprint, think of it that way. And I said, and then there's all these people on the boat with nothing to do. So my entrepreneurial mind said, let's get those papers to the boat. So I would go with my bike, this is at age 12, load up with papers which are going to be thrown out anyway, and then go to the boat and sell them on the newspaper. I'd go on the boat and sell them on the, so, people would be sitting there for 5 minutes and like, well, this is nice. And like, what am I going to do? So by the time the boat left, everybody had bought a newspaper pretty much. And my hands were filled with ink. And I gave the people who let you on the boat, a little extra tip to kind of keep this whole thing moving. And I made a ton of money, 25 cents, 50 cents at a time, one boat after another. And I just go back and get more newspapers and so on. So That's my first experience of money. I was earning it by just seeing an opportunity there, and I would put that money into investing, and I bought myself a whaler, and
Oh, wow.
so that was the very, very beginning. That's kind of been my model: is providing content, but monetizing it and helping consumers find great resources, and helping financial service providers find customers. So that's kind of the way I've looked at it.
Awesome. So what kind of meaning did that create for you around money? Like, what does money represent to you now?
Um, Opportunity to do what you want, and um, to me, it's really the opportunity to help other people. That's what it comes down to. Uh, if you're poor, you don't think about anybody else. You're in survival mode. I guess in the Maslow hierarchy of needs, you're at the survival at the lowest level. If you're in survival mode,
Right.
the more money you have and the more financially stable you are, the higher you're able to move up the hierarchy of needs towards enlightenment, which is like helping other people because your basic needs are taken care of. I guess that's the way to think of it. So money allows you to do that. So I give back in all kinds of ways. I do tutoring and speaking, and I help all kinds of people on which I make no money whatsoever, but it feels really good to be able to give the knowledge I have back to people who need it. I'll just give you a funny, just yesterday, I was doing a radio station in Philadelphia, and this woman emails me and just gives me this incredibly long story about battling with her brother over an inheritance. I won't go into the details of it, but this woman is living on disability and is barely making it, and there's $375,000 waiting if she can only work this thing out. She has no advisors. Her lawyer is completely worthless, and I spoke to her for like an hour trying to help her navigate this whole thing. I'm not making any money from this whatsoever, but it feels good to help these people who hear me on radio, and then I engage them, and so I guess it's good karma in the world.
Yeah, I mean, so that leads into a really interesting point. I mean, you mentioned Maslow's hierarchy of needs, and you mentioned that you talked to her for like an hour trying to work through this. And oftentimes when we start with people here at Mindful Money, what we find is they're stuck in that bottom layer, even if they have money. Like I know people that make $50,000 a year. They have a regular job. They're not quote unquote an investor in the conventional sense. And they still feel like they don't get all the things that they want and that they're not happy. So it sounds like there were a lot of blocks on her end, and I'm wondering what you've noticed about people and how they get in their own way when it comes to that freedom that you talk about. Like, is there...
Not just blocks. You're correct.
Yeah.
One of the books, I've done 13 books. One of the books I did is called Master Your Money Type, where I get into this in great detail, and I break people into 6 different money types and explain how they got there, both financially and psychologically, and then what they should do since they're there going forward financially and psychology. And basically, I don't say, you're in a bad money type. You shouldn't be that. You should be something else. Like, no, this is what you are.
That word "should" is dangerous.
Be the best you can be within that category. Okay.
Right.
So, that's the idea. Is that so? I'll just give you briefly what the 6 money types are in no particular order. They're the high rollers. They're the ostriches. They're the let me just remember all of them here. The high rollers, the ostriches, I'm just trying to remember. Let me get them all here. Oh, the squirrels.
I like the metaphors.
Strivers, the debt desperados, and the coasters. Those are the 6 different types I have. Nice. And basically, I'm saying, based on the way you grew up, this is what you are. So I'm not. If you're an ostrich and you don't want to deal with money, and it's like a real pain, you don't open your statements and all that. It's like, okay, that's what you are. Be the best ostrich you can be. Don't say I should be a high roller. It's like you are an ostrich. Fine, just be an ostrich. So that's the whole idea behind is to make the most of your money type. A lot of people said, no, I don't want to be an ostrich. It's like, you are an ostrich. So
right.
Go for it.
Right. So
that's the idea. So anyway.
We can cut that out. And if you need to answer that, we can pause.
Let's pause. Hold on for a second. Sorry.
That's fine.
Right. Hi, Ellen. I'm in the middle of doing an interview. Is this urgent this moment? Okay, let's talk later. Okay, bye.
Right. No, that's fine. I marked it, and we'll cut it out.
Sorry, I wanted to tell her not to call me back.
No, I understand.
Phone off.
All right, one second.
Sorry about that.
No.
You know what? Let's do it since she was distracting me. Let's do the money types again where it's a little cleaner?
Yeah.
Because I was
Yeah. You were a little bit. Okay.
So let's go right back in and have a clean version of that. All right.
Yeah. So just start from the different money types and just give it a second of silence.
So I did a book about all these topics called Master Your Money Type. And there are basically 6 money types that I talk about. One of them is the high roller. There's the squirrel, the ostrich, the coaster, the striver, and the debt desperado. Those are my 6 types.
Nice.
And I go into the psychology of how you became that, not only your upbringing, but kind of what financial circumstances you had, and then what you are now and what your path forward should be, both financially and psychologically. And basically what I'm saying is, if you're a particular type, it's not a bad thing. You just are that, and be the best you can be. If you're an ostrich, be the best ostrich you can be. Don't say, I should be a high roller, because you're not going to be. So I think that'll help a lot of people in understanding what they are. And by the way, if you're going to get married or you have a significant other, see what they are, because sometimes it's good to have a bit of a contrast. If you have 2 squirrels that are kind of very run by fear and penny pinching and all that, not much fun to be 2 squirrels together. But sometimes a squirrel and a high roller is kind of a good combination. So these come from how you were brought up and what your parents' attitude was and what your financial situation was.
Of course, the beliefs you take on about the world and how it works and who you are in it, your identity, really.
And you can come from a background and do the same thing as your parents in your situation, or the opposite.
Right.
So, for example, many baby boomers were brought up. Baby boomers tend to be coasters, generally positive, things are kind of going along okay. And they would tend to be brought up by squirrels. Their parents were kind of brought up in the Depression and were all about fear and loss and penny pinching and survival. So the baby boomers who grew up in a much more prosperous time did not become squirrels for the most part. They were, in general, more optimistic. So you don't necessarily have to take on what your parents went through. You could do something different. In fact, in many cases, you react to it. They didn't want to be squirrels. You know, in the 50s, 60s, 70s, things were pretty good, and they were into prosperity and enjoying themselves and so on, which has its downsides because they weren't planning for the future. The opposite of their parents, who were consumed about the future and holding on to every penny as long as possible. So there's a lot of interesting psychological dynamics between generations.
Oh, absolutely. And, you know, so if I'm an ostrich, let's just take that metaphor, right? So if I'm an ostrich, and I don't think I am, but let's just hypothetically say, if I were, burying my head in the sand, you're saying be the best ostrich I can be. Well, how can I do that and still plan for the future and still get the things that I want without neglecting what's important?
So if you're an ostrich, what you want to do is to set up as many automatic things that are going to happen that are positive for you, because you're not going to get around to it otherwise. So use your inattention to your advantage. Okay, So certainly, for example, you have a 401k, sign up for that for the max. In addition to that, do some kind of automatic investment plan where automatically $100, $200, whatever you can afford, automatically come out of your checking account into an index fund or something simple where your money is going to be growing. So because it's automatic and you're not thinking about it, the right thing is automatically happening, okay? Because you're not going to watch the stock market. You're not going to open your statements. You're not going to kind of pay attention to this stuff. So I like to have automatic good habits working for me instead of what most people do is automatic bad habits. They pay the minimum on their credit card. They're paying very high interest rates. They don't invest at all. Their money is sitting in a savings account earning zero. So they're in automatically the bad habits. So that's what I'm saying for an ostrich is set it up so you don't have to think about it, but the right things are automatically happening.
Yeah, and there's something to be said, I mean, about those savings accounts and the easy access to your money, but at the same time, you want to stay balanced. It's interesting that you mention this idea of not paying things down. You know, I think you mentioned the car payment or a student loan or something like that. And I saw a video.
Right.
I saw a video where you were actually talking about not overpaying.
Right.
So what's up with that?
Well, I mean, people in many cases have a huge amount of debt for much longer than they really need to. I'll just give you one example of something that could help your listeners maybe.
Sure.
I'm a big proponent of what's called the mortgage equity optimization model or strategy. And that literally allows you to pay your mortgage off in about 5 to 7 years instead of 30 years on your existing level of income. Now, this is something you'll never hear about from a bank. They don't want you to know about
Well,
this.
yeah, they're the ones that own the mortgages.
They're the ones and they're getting all the interest. Remember, the mortgage, all the interest is front-end loaded, right? So the first 10 to 15 years is very little principal. It's mostly interest.
Mm-hmm.
So in fact, they would encourage you to refinance and start a new 30-year clock all over again. That's what the banks would say is a great idea. So mortgage optimization does the opposite. Your money is working for you every day, paying your principal down at an accelerating rate until you've paid the thing off completely. There's a website to help people with that, which is truthinequity.com, truthinequity.com. They model it for you. They show you exactly, put in a personal profile, all the numbers, and they say, based on what you're doing today, it's going to take you 28 years to pay off your mortgage. With the numbers you just gave us, it's going to be 5.6 years or whatever it comes out to be. And then step by step, they take you through it. So there's an example of using your money for your benefit instead of the bank's benefit, and literally saving 25 years off your mortgage and tens of thousands of dollars in interest.
Wow. And what's that website one more time?
Truthinequity.com.
Great.
And I've been working with them for over 10 years. I've sent over 50,000 people to them and transformed many, many lives, because most people think, well, that's what I do. I keep my money in a checking account earning zero. I pay my mortgage for 30 years. I refinance, get a lower rate, and then they start the clock all over again.
Well, I mean, that's what we're mass marketed to with media. That's what we're told to do is, hey, you know, the Gen X, the generation, I'm a millennial, so my parents were told, okay, go to college. We're not even going to get started on this, but go to college, get a job, you know, take out a loan, get your house, get your car, and then just work on paying that off. That'll be a happy life. And then retire and hope that you have a retirement when you do. So
what's happened to that model is a lot of people are getting to retirement and don't have much saved at all, and their house isn't even paid off.
Right.
Even if their house is paid off, they're what I call house rich, cash poor. And they've got this wonderful house around them. They don't have enough money to pay for the groceries. So you've got to do something different, and particularly younger people. I mean, you can imagine a 25-year-old buying a house and having their mortgage paid off at 30 instead of 60.
That's a big deal.
What difference does that make, right? And that's what mortgage optimization allows you to do.
Yeah, so we have all this. We have the mortgage optimization. We have, you know, saving and investing, which is a lot of what you talk about is different ways to invest and make money. We talked a bit about this ostrich thing and how setting things up on automatic, which is something at Mindful Money that we talk about a lot. Is the very first step is I'm like, okay, establish yourself with a savings account if you don't have one already, not to save, but just to get in the habit of not thinking and
not spending.
Exactly. And
so that's good. Savings is good, but I want people to have it earning something.
Absolutely.
There's about $10 trillion sitting in savings accounts, CDs, money market funds, treasury bills, literally earning zero. And it's going to stay that way as far as the eye can see.
Well, it's going to go. It's not going to be. It's not going to be as valuable in 10 years. It doesn't keep up with inflation.
Correct. So you need to make that money earn money. And I'll just give you something I'm involved with, which might be helpful to the listeners as well.
Sure.
Which are called commercial real estate income funds, where you earn 8% yields very safely, minimum hold time 18 months, no commissions or fees of any kind, and you get monthly checks, and you can either take them or reinvest them back and have your money growing at 8% instead of zero. That's a lot better. A website for that, commercialrealestateincomefunds.com. And what they do is they're lending money to high-quality commercial projects that use it to renovate or improve themselves over a 1-year period, thereabouts. And then the project is done, they pay the money back, and they do another. There's a whole portfolio of maybe 30 or 40 commercial real estate income fund projects in one fund. And you don't have to, it's completely passive from your point of view. And there's a way of earning 8% instead of zero with something that's really quite safe. So
yeah, and that's stuff that, I mean, I just started reading Tony Robbins' new book. That's something he talks about, is this idea of compound interest, and somewhere between a 7 to 9% interest rate is the key. Because when you have that, you can double your money in 7 years.
Right.
So, and I like that you mentioned that it's completely passive. One of the things that we really stress is removing this idea that two Harvard professors, actually I just said from Harvard, but so two Harvard professors came up with from their studies and their research, they call it bandwidth tax. It's essentially decision fatigue. So if I have to worry about paying for the groceries, paying for the mortgage like you're talking about, earning money and all these things, that will actually make me dumber. Like they literally proved it brings you down like about 15% percentage points or 15 IQ points, which is the same as being drunk. So that's just not cool.
Yeah, if you give people too many decisions, they'll make none, basically, or they make the wrong decision. I mean, a classic case of that would be you start a new job and they give you the 401k packet. It's got 50 choices. So what you do is you just keep it in the money market fund and do nothing. I see this all the time. It's too overwhelming.
And they don't ever rebalance or anything like that.
They don't even know what any of this stuff is.
And that's most of our audience, I think, doesn't either. They're in the mentality that like, I don't have enough, right? They're in that lower level of Maslow's hierarchy of needs, and I think a big part of that is due to this decision fatigue. Have you ever heard of the jam experiment? Yeah. So for those, we mentioned that on, I think, one of the early episodes, one of the single-digit ones, like episode 2 or 3. From your perspective, how does the jam experiment, tell us a bit about what that is, but how does the jam experiment play into finance?
Well, people just get overwhelmed and then they end up doing nothing is what it comes down to, And I've just seen this time after time. People call me and they send me their 401k statements. It's like, am I doing the right thing? It's all in cash. It's like, no, you're not doing the right thing. But what are all these things? Nobody ever explains any of these things to me. So, it's just typical. And I mean, there's a big need for personal finance education. I mean, part of what you're doing is good, but people are thrown into the world and you see the results. They're not allocating their 401ks correctly. They're getting to huge amounts of credit card debt. They're making the wrong decisions on mortgages. People are financial mess because they're not teaching this stuff. In fact, I mean, I teach at schools. I've done some things at schools. I went to one college, which I'll remain unnamed, and I went to the economics department. So I'd like to give a speech to your students about personal finance and 401ks and credit scores and all that. He said, oh, no. That's too practical. We're academic.
Wait, he actually said that?
He actually said that is too practical. They'll deal with that when they get out of here. But we need to do algorithms and formulas and theoretical stuff. And I think he said it has to be academically rigorous. That's what he said.
Well,
yes.
but they don't deal with it when they get out of there. You only encounter really 2 types of education: the ones that teach you how to balance a checkbook, or the ones that teach you how to invest in 401ks. If you even choose to go down that road, like there's nobody talking about this conversation of appealing to your needs, even.
Right. Right. But I'm just saying, this is a classic attitude. It's like, I mean, I went not too far from you to Amherst College. Wonderful place, top school.
Yeah.
If you wanted to, there's no course on personal finance. It does not exist. It's all macroeconomics and all these formulas, and it's all mathematical. But, what do you do with your 401k? How do I get out of credit card debt? We talked about mortgage optimization, right insurance policies, paying taxes. All this practical stuff is a complete mystery to most people, and they're thrown into the world without having a clue.
Right, and it's because they're stuck in that lower level. So a lot of people actually think that they're going to be happier when they have more money. What do you think about that?
They find a way to spend it, is usually what happens. Your consumption rises to the level of your income, if not beyond. So that's typically what happens. You should always understand. I mean, the people who are really wealthy, Warren Buffett, there was a book called The Millionaire Next Door, kind of a famous Thomas Stanley book, talking about the people that really did well, still live in the home where they grew up, and they still have the same car that they're from 20 years ago, and they haven't upgraded, and they're millionaires, but they don't live like that. So those people probably are much happier than the people who spend large and make a lot of money and spend larger. What just came to mind was Jordan Belfort and the Wolf of Wall Street.
Yes.
Right? I mean, he made a lot of money, but he spent way beyond what he was making, and the more he made, the bigger the cocaine parties were, the trips to town.
Right. So it's not about the amount that you make, really.
No, it's making the most of it, and being satisfied. But making your money grow is the main thing. And then, I mean, people are going to live a lot longer. The fastest growing part of the population is 90 plus these days.
Really?
So yeah, a lot of people making it to 90, 100. That's nice, but they don't have enough money to survive this long. So longevity is great, except for people. So what's happening is older people, 70s, 80s, 90s, running out of money, are moving back with their kids. Yeah. Right? The baby boomers, the people in the middle, are being hit by both generations. The college kids, their kids, over 50% of them are graduating and moving back home because they have huge amounts of student loan debt and they can't afford to kind of get started on their own. So those are what I call the boomerangers. They keep coming back. Investors, but they're the boomerangers. They keep coming back. And now you've got the reverse boomerangers, which is the parents moving back with the kids when they run out of money when they're in the 70s, 80s, 90s. Right? So you've got the boomerangers and the reverse boomerangers at the same time.
I love your metaphors, by the way.
Because people are not preparing. I mean, the amount of student loan debt people are getting into is really changing society in a major negative way.
Yeah, and I mean, you know what?
Graduating with $38,000 in debt.
Exactly, $38,000. That's not even counting interest, and most people are expecting. So we found a statistic. I've talked about it on previous episodes. 60% of people are graduating expecting to be in the top 20%.
Not going to work. The numbers.
You just don't.
It's like everybody's above average, right? Well, somebody's got to be average, you know.
Yeah,
so
exactly.
38,000 is the average debt. Now, a lot of people, 150,000 undergraduate, law school, business school, medical school, another 200, 300, 400,000 on top of that before you got your first job. How are you going to get out of that? So
exactly,
it's enslaved people in many cases. This became a big political issue in the last campaign, but it's not going to go away. Bernie Sanders is not going to wipe away your student loan debt, so don't expect that to happen anytime soon. Yeah. So it's a problem. So let me just give some help on that area, if it goes, because that probably a lot of your listeners would be in that.
They absolutely are. Absolutely. Yeah.
So 2 things you can do. You can consolidate your student loan debt. If you've got a whole bunch of it at different interest rates all over the place, there's a website, consolidatecollege.com, that can help you do it, even if you're behind or delinquent or having your wages garnished. There are ways of kind of working that out. So consolidate it all. That's for federal loans for the most part. And then a lot of people don't realize you can actually refinance your student loans to as low as 2 to 3%. Wow. A lot of people are paying 5, 6, 10, much higher rates. Consolidate your private loans, your federal loans into one new loan at a lower interest rate. There's a place called Credible that helps you do that. Credible.com, and then do /money answers. I know it's me that way. You get $200 off your first payment that way. And so you can do that. That could save you a lot of money.
You know, I think one thing that people don't consider too. Thanks for those. And one thing that I think people don't consider is we talk about, and Tony and you and all the financial experts out there talk about this idea of compound interest and the fact that you can grow your investments by looking at a 7 to 9% interest rate, but I think what a lot of people miss is that 7 to 9 interest rate can also apply to your debt, and sometimes it's even higher, and that grows your debt at that same rate too.
So I say there's a big difference between negative and positive compounding. Negative compounding is where the money is piling up against you. You're paying the minimum on your credit card, and you owe more and more every month. Remember my money types, one of them is called the debt desperados. Mm-hmm. Those people think the way to get out of debt is to go into more debt, basically. Okay, so that's the people at the gambling tables where there's an ATM right there. It's like insane, but let's borrow at 18% to put my money on red or something. This is going to work. So that doesn't work out too well. So that's negative compounding, as opposed to what we've been talking about, positive compounding, where your money is producing more money and compounding. Einstein called compounding the 8th wonder of the world. And it's what a difference in your lifestyle to have positive compounding versus negative compounding.
Exactly.
So I want your listeners to be on the positive compounding and do a lot less of that interest piling up against you all the time.
Well, and I think that that's really one of the secrets to financial wealth. I mean, not even talking about living a balanced lifestyle, which is a lot of what we focus on, but just financial wealth is that idea and understanding of positive compounding. And
it is.
Let's talk a bit about what you call white knight syndrome, because we've talked a lot about the problems, and I think that people have this idea that something is going to come in and save them. You mentioned Bernie earlier.
Right. So white knight syndrome is the feeling that I know my finances are a total mess, but this one event will come out of the blue and save me from all my bad habits. It could be a lottery ticket. It could be an inheritance. It could be something that's external from my life. And occasionally this may happen, not very often, and certainly not something you should count on. As you know, I was at Money Magazine for 18 years. We actually did several stories 5 years later on people who had won at least $1 million in the lottery.
Oh, boy.
And most of them were bankrupt.
Yep.
Because they'd given away, or they'd invested in all kinds of strange things that didn't work out before they even got the money. Okay. So just even when the white knight does arrive, which is rare, that's not necessarily the solution to your problems either.
Yeah, you got to learn how to fight. Just a little. So we talk a lot about, we've talked a lot here on this episode about a lot of the things that people can do, a lot of the problems that exist, but also I have this question for you, and I think we this came up when we started to discuss student loan debt and the state of the economy, really, and the fact that people are severely underestimating the amount of debt that they're going to be in and what to do about it, and that Bernie and the White Knight won't save us. So, if we take a few steps back and just look at this societal box that we've built for ourselves, I'm curious if there was one thing that you could change in the world that would have a huge impact on people's lifestyle and finances, what would that be?
Well, I just think it's financial education, getting people learning about these things earlier and taking action. I've been in the personal finance field for almost 40 years, and I always say the two greatest forces in personal finance are inertia and apathy. People don't care or they don't do. As crazy as that may be, that's the reality of it. I hand people diamonds and jewels and fantastic ideas, like what we've talked about with truthandequity.com. I've just given you an idea that can take 25 years off your mortgage and save you tens of thousands of dollars if you do it. And a lot of people say, yeah, and they don't do it. So it's like,
so do it today.
Do it today. That's the action part, okay? Overcoming inertia. And apathy is the other one. And we talked about ostriches, but a lot of people just don't care about their own personal finances, as crazy as that may be. They think somebody else will take care of it. For, oh, my cousin Vinny is good at this stuff, so he'll do it. Or,
yeah, I just got to have a conversation and have all the answers.
Yeah, and so the real solution is to get your mind and get involved and take action and learn and grow and do these things, and you'll do great. Don't be inert about this stuff.
Yeah, it's really a mind shift. In the first few episodes, we had this segment called the Mindful Money Mind Shift, and frankly, we ran out of shifts until we started interviewing people. So that's exactly, I mean, that's what you're saying, is it's get into the habit of learning and then applying.
Absolutely. No matter what your parents have done. Okay, your parents maybe have done terribly and not done it all. It doesn't mean you can't do really well, and you see that all the time. Your parents might have done great and learn from that. So it's this whole intergenerational wealth thing is something I'm very much involved in. And in many cases, wealth is squandered on the next generation. They're just not ready to receive it.
Yeah.
And
that's the generation we're moving into. I mean, by 2020, the millennial generation is going to have $7 trillion of liquid assets. I'm sure that's a number you've heard before. I mean, that's a big deal.
It is. It depends what they do with it. I mean, if you're coming out of college and you've got $50,000 in student loan debt, it really affects your psychology. You become kind of, in my money types, I guess you become a squirrel or an ostrich. It's just like overwhelming. You don't have that kind of.
And it creates a psychological message that they don't have enough too. That's what we encounter constantly. I ask people, hey, what are some things that you don't think you have enough to afford? And we like to say that we solve the problem of happiness with habit hacking. So what are the problems that you don't think, or what are the things that you don't think that you can afford? I do out the math. I'm like, you have an extra couple $100. Why don't we take half of that and put that toward all these important things that you think are important and that aren't fulfilling you? And that's exactly right. Like, it creates this block.
It does. You're right. So yeah, getting into the habit where you have positive compounding working for you, not negative compounding, and getting things that make you feel good. I mean, so much of money is psychological and emotional. People think it's financial. It is, but a lot of it is how you feel about it. The solution to your problems is between your ears. Okay, it's not out there. It's your attitude. It's the way you think and how you make things happen. I want to give you the one word that's the secret to business success. Are you open to that word?
I am.
Leverage. And I don't mean debt. Leverage means using your capabilities, your knowledge, and combining it with those of others to have unlimited upside potential to make things grow. So you only have so many hours in the day, and you can only do so many things yourself. But if you work with other people who have other talents, maybe finances, other expertise, other contacts, working with yours, the two of you, 1 + 1 can equal 3. So the idea of leverage of your talents just gives you huge potential to improve. And a lot of people don't think that way. It's like, only what I can do. Well, that limits. And if you're particularly in a what I would call a time for money situation, you're a psychotherapist or something, and you get $100 an hour, you're limited by the number of hours you have. There's no leverage in that.
Right.
So if you can do something that's got leverage, and I'll just give you an example we've talked about before. I refer people to Truth and Equity. I don't do the Truth and Equity thing. They do it, but I refer people to it. They get fantastic service. They save tens of thousands on their mortgage, and I get a little something for referring them to it. So I don't have to be the one doing the truth and equity, but I'm referring them to it. So I help the customer save tens of thousands of dollars on their mortgage. I help truth and equity get a customer out of it, and I get a little something. That's an example of using leverage to really succeed in the long run.
Yeah, that's a great example. And one thing that stood out to me when you described your money types is it's also leveraging the weaknesses too, because if I know that I like to bury my head in the sand, using the ostrich example, and I want to ask you a little bit more as we kind of start to wrap up here about these types, but if I bury my head in the sand, that I could see that as a weakness or something I can leverage to say, okay, how can I use that, what I call a weakness, to the best of my advantage? And that's actually, frankly, that's what started way back in the day, mindful money for me, is I didn't even want to look at my money, and I was just like, all right, I'm sick of this. How can I automate the whole thing? So
exactly. Well, you sound like you're an ostrich, actually, but you're making the most of your ostrichness. You're being the best ostrich you can be.
I have to be, Yeah. And then I realized that not everybody's like me, so I had to create other dimensions that help all the other people as well. So
for an ostrich, a robo-advisor is the best possible thing because it's automatically going to make the right things happen as opposed to automatically the wrong things happen, which is what happens with most ostriches. They don't think about it. Credit card interest is piling up. They don't look at their statements. They have no idea what's going on, and bad things are happening. Using your system in mindful money, automatically the right things are happening, and they're still not thinking about it. What a difference.
Yeah, exactly. So let's go through. I mean, you have six different types. I would love it if we could touch on at least three and talk about what a couple of key traits are, and then what people can do in those situations.
Let's talk about the coasters, which is one of the biggest categories. Coasters are people where things are pretty much coasting along, and everything kind of seems fine until they hit what I call financial brick walls. Like, oh, the kid just turned 17. I guess we should start saving for college.
Oh, yeah.
I just turned 58. I guess we should start saving for retirement. Everything's been just fine. Like, and they're coasting along, not realizing there's these big issues kind of hanging out there.
You talked about that in some of your videos I found online, too. You were talking about, I think, retirement, and people get to like 65, and they're like, oh, oops.
And that happens a lot. A lot of people getting to retirement these days without having saved any. 40% of the people receiving Social Security income, retirement income, it is their only source of income. They've not saved a dime. Wow. It was never designed that way. It was designed as a supplement to your investments and your pensions. It was not supposed to be
the education that we don't have.
Yeah. So exactly.
So what can they do?
The coaster, you've got to kind of, even though things seem okay, you got to set up automatic systems so that these don't hit you. You have a new baby, put money into a college 529 plan on automatic pilot. So it's growing and growing and growing. And by the time you get to college, it's not going to be a huge shock, which is what happens. People get to 17 and say, well, I guess we should start thinking about college now and scholarships. And, somehow I'm going to get bailed out, and they don't. And they take huge student loan debt, right? So you can see that.
And that 529 plan is passive as well. I think you had a link to that too, didn't you?
Each state has their own 529 plan.
Okay.
And you don't have to stick to your own state. In many states, you get to deduct it from your state income tax. So It can be a benefit. But my favorite plan happens to be the Nevada plan, which has Vanguard funds and so on. But yeah, you can go anywhere to get a 529 plan. But set it up on automatic pilot. Again, the money is growing tax-free inside there. As long as you use it for college expenses, it remains tax-free. Government's giving you a break, take advantage of it for college. Same with a house down payment. Today, you need typically 20% or more for a house down payment. This is not going to happen instantly. So save up on a regular basis and have it grow. Don't just keep it in a savings account earning zero. I mentioned the commercial real estate income funds as a way of earning 8% to build up for a down payment. Okay. So just think of a wedding can be $50,000 easily. It's just like, don't decide to get married and have money the next day. Save up for these kind of things. So all these things are completely predictable, but people put it off. And then when the event happens, they're like completely shocked. It's like, well, I should have been doing this all along. So that's what we need for a coaster.
Okay, so we have the ostriches, we have the coasters.
So let's do the debt desperados would be a good example. Okay, so debt desperados are people who think that if by going into debt, everything's going to get better, basically. And it's worth it to go into debt because whatever they're investing in or spending is going to pay off. And usually it doesn't. and they go deeper in these cycles until they hit rock bottom, and then they kind of have a conversion. It's like, this is not going to work. So some specific advice for debt desperados. First of all, stay on top of your credit score. A lot of people have no idea what their credit score is whatsoever. Stay on top of it and make sure it's as accurate as can be. In many cases, there are errors in your credit score, and you're going to clean those up because you want to get your credit score higher instead of lower. If you're way over your head in credit card debt, go to a nonprofit credit counseling organization, because they can actually help you get out of debt in a way you can't possibly on your own. To some extent, imposing a discipline on that you don't have yourself. They're going to close credit card accounts. You're going to make one payment to them. They're going to pay the creditors, and in 2, 3, 4 years, you're out of debt. My favorite one's actually in your neighborhood. It's called Cambridge Credit Counseling. Their website, cambridgecredit.org. Their phone number, 800-897-2200. They've helped millions of people. There's about 7 million people in America right now in so-called debt management plans, DMPs, where they get lower rates from Chase and Citibank and Bank of America that you couldn't get on your own. You make one payment to a Cambridge. They're going to then pay the difference, and over time you can get out of debt. You need that discipline if you're a debt desperado, hopefully before you've hit bottom, because at a certain point, nobody will lend to you anymore, and you can't keep going. So there's a kind of a psychology of instant gratification, and I want it now, whether I can afford it or not. The last Christmas, this happens typically most Christmases, they did a survey in early December, and 40% of the people said, I'm going to go buy Christmas presents, knowing in advance I don't have the money to pay for them when the bills come in January. And they went ahead and did it anyway. Yeah. That's kind of classic debt desperado mentality. I've got to have it now. I'll figure it out later. Well, later arrives, and it's often painful for people.
Are these things that people are just debt desperados or just ostriches? Because you're talking, I'm like, okay, I think I might be a mix here.
Yes, it's not your only one or the other. You have probably the strongest one, and then maybe a touch of some of the other ones. It's not as though you're only one thing or another, but you want to see what your dominant one might be. And then also, if you have a spouse or significant other, you're going to get married with somebody, have this discussion of what they are, because often the men are more aggressive and the women are more conservative, and it can be a good balance, but sometimes it can cause a lot of trouble. I mean, over 50% of divorces is because of financial incompatibility. So you really want to kind of figure out what the mix is of your money types before you do it. They can find out about this book again called Master Your Money Type at my website at moneyanswers.com. It's a lot of fun to actually understand these things, the psychological aspect of it as well as the financial aspect. And you can do much better by accepting what you are and saying, I'm going to do the best I can within my money type. A lot of people read it and say, oh, no, I don't want to be a debt desperado. It's like, no, that's what you are. Look at your pattern. Deal with it and be the best debt desperado you can be.
Absolutely. It's acceptance. It's the very first principle that we talk about in our book. We have a book that we just published, 5 simple hacks to do to increase your prosperity. And the very first one is acceptance. Like, realize that you've always been okay and that nothing is wrong, and then choose to take a step.
Instead of beating up on yourself all the time, what I would call a super ego attack. You're attacking yourself for being what you are. It's like, no, that's what you are. Accept it and move on. It's much better that way.
Yeah. Awesome. Well, hey, America's Money Answers, man. I really appreciate you taking the time here. We've got a lot of gems.
Yeah, I'd be glad to get emails from you folks at moneyanswers.com. Lots of resources. I just love to help people in these areas. So if I can help your folks, be glad to do it.
Absolutely. And I'm just going to pause here for one sec. One question I forgot to ask you before we started was, is there any kind of special promotion that you're doing right now that we can offer?
Not particularly. I mean, I give away a lot of stuff free, so there's no specific promotion. No.
All right, cool.
Not really. I mean, one other thing I just thought of that we didn't mention, let me just show you one of my other books.
I like that you're wearing shorts in the winter, by the way.
Absolutely. It's hot in here. It's hot. I did this book. Can you see that? The Ultimate Guide to Student Loans. So we talked a little bit about it, but this may be relevant to people in a bunch of different ways too. I mean, this is about planning for it in the first place and getting the best loans and paying them off quicker. Anyway, I'm just trying to think of your audience as kind of student loans is probably one of their biggest things,
It is, absolutely, yeah. So
I'm going to, but I just wanted to mention that as well. I mean, that would be one thing that might be directly relevant to your folks. You know?
Yeah, I'm going to do that close one more time. And then if you want to talk, you mentioned your website and then also maybe mention that book.
So it's called The Ultimate Guide to Student Loans. That's what it is.
All right, cool. Hang on. All right, America's Money Answers, man. I really appreciate you taking the time here with us today. You gave us some really good gems and some good diamonds here in this podcast. And everyone, if you're not subscribed to Jordan's stuff, go subscribe. He is a wealth of knowledge and advice, and get started on those tips today. Don't procrastinate. And Jordan, where can people go to connect with you?
So my website is moneyanswers.com. I've got links to all my different books and videos and online things and my speeches and radio and TV stuff. There's just a lot of stuff there. One book that might be particularly relevant to your audience, I did a year ago, called The Ultimate Guide to Student Loans, about the whole process of doing it right in the first place, saving, getting the best loans when you get to college, paying them off as quickly as possible. That's the problem, the biggest problem of this generation, and that's why I did a book on that particular topic.
Awesome. Well, thank you so much for taking the time, my friend, and until next week, thank you guys for listening to the Mindful Money Podcast. You've been listening to the Mindful Money Podcast, a podcast for people who want to align their money with their values. Love this show? Head over to iTunes to subscribe, rate, and review. Want more incredible show content? Head over to mindfulmoneypodcast.com for show notes, past episodes, and a sneak peek at what's coming next. In next week's episode of the Mindful Money Podcast.
But even if you were in a job and it was with a boss, it's not that they're not paying you enough. We take it as we're not making a lot of money, so we're not good enough to make more money. It's our fault.